This is the halfway point of the course, week 5. This week, we're going to talk about section 3 of the business plan, which includes finances. You'll be creating an income statement, balance sheet, and cash flow statement. It'll cover parts 8, 9, and 10 in the written rubric. Even though the rubric is asking for 5 years for each, I only need 3 years for all of these different financial statements. Okay, let's start out with the income statement, or point 9 on the rubric. This is where I'd suggest starting with your financials. This demonstrates a realistic and attractive investment potential of your business. It is consistent with the operating and marketing strategies that you've outlined in the body of your plan, and it needs to be detailed for only the first year, and that means month by month. The next 2 years can be reflective of annual numbers. On a side note, if you think your plan is more convincing and profitable when you project numbers through a few more years, maybe through year 5, please do so. We can expand out the template, I'll show you in a little bit, and make it easy for you to do. The balance sheet, or point 10 on the rubric, needs to present a realistic assessment of the working capital and fixed asset requirements of the business. It needs to appropriately reflect the projected capital structure of the business and show long-term debt and equity positions. Again, you need numbers for at least 3 years here. Finally, the cash flow statement, or point 8 on the rubric, needs to present a realistic assessment of the cash requirements, both the inflows and outflows over a minimum 3-year period. Once again, the first year is detailed or month by month, and the second 2 can be just annually. These need to be consistent with operating and marketing strategies outlined in the rest of your business plan. So basically, what you've been presenting to me and so far and writing about needs to match with the financials logistically. Or if they don't, you need to change either the financials or the text in your plan. Okay, you need to outline the specific cost to produce your product or provide your service, then determine profit margins and set your price, and finally project sales for the first 3 years at least. Of course, there will be a mixture of other important numbers to include as well. Okay, now let's take a look at some of the numbers you'll get to determine in your financials before we hop into the examples. I think learning through example is key in this section 3. Of course, I'll say this a few times today, but if you need help with this or numbers aren't your strongest talent, please don't hesitate to reach out through phone call or text or email or by setting up a Zoom meeting. I'm more than happy to help you with figuring out these financials. That's what I'm here for. Okay, so the income statement. You get to start out by listing your projected sales for either your products or services offered. Obviously, if your business has both, list them both. This is the simple place to start if you're dealing in a commodity market where the price is basically set for you. However, if you aren't in a commodity market, it might be a little challenging to start here if you don't have a price determined. In that case, I'd suggest working on your expenses first. These can include both the cost of goods sold and operating expenses for the business. Under the cost of goods sold section, and you should include direct costs that are related to the product or rendered services sold, and record during the counting period. This can include raw materials or products, including the shipping charges. Now I'd like to keep this section pretty simple for this class, but if you're interested in utilizing different accounting methods like first in, first out, or last in, first out to determine the value of the cost of goods sold, feel free. Otherwise, just use the average cost method, where the average price of all the goods in stock, regardless of purchase date, is used to value the goods sold. This takes the average product cost over a time period and has sort of a smoothing effect that prevents the cost of goods sold from being highly impacted by extreme costs of one or more acquisitions or purchases. Basically, just record whatever your costs are for acquiring the materials annually. Just make sure that the inventory you sell reflects the cost of goods sold line. I'll show you this better when we look at an example. Let's move on to the operating expenses. This section is where you need to consider and record costs for things such as marketing and advertising, rent of land or buildings, technology, interest on loans, depreciation of assets, your salary, and your employees' payroll. This list will obviously be customized to your business with additions and subtractions from the basic list here. Just a note, it's smart to estimate expenses high and sales low. This will allow you to be more flexible if sales aren't what you projected or expenses are higher priced or more plentiful than you determined initially. Finally, income tax will be recorded on the income statement, and that will be a flat 30% of your net income before taxes. That's a lot, I know, but that's what it is. Okay, time to discuss the balance sheet. A balance sheet reports a company's assets, liabilities, and shareholders' equity at the specific point in time and provides a basis for computing rates of return and evaluating its capital structure. It is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. There will be lines here to record assets, liabilities, and shareholders' equity. The balance part of this name comes from the basic balance sheet equation, which is assets equals liabilities plus shareholders' equity. Under assets, there will be lines for cash, property, equipment, and land. Obviously, there are a lot of other headings as well, but those are the main ones most of you will be focusing on and putting numbers into. Under liabilities, many of you will record the non-current portion on a long-term loan you've taken out to cover startup expenses. This is a number that shows how much principal is left due on your loan. Equity for this class is broken down into capital investment and accumulated retained earnings. Capital investment is where you record the money you bring into the company, and accumulated retained earnings is the row where you will get your balance sheet to balance. There's a formula built into the template, I'll show you that in a second, and it takes assets minus liabilities and sets that equal to accumulated retained earnings. Thus, your assets will equal your liabilities plus your equity. Earlier, I mentioned that the balance sheet is a snapshot of what your company owns and owes. This is a key to understand. For this class, I'd suggest dating this balance sheet at the end of the fiscal year, like December. This will allow you to take off lines ending in payable, assuming you've paid everything by the end of the year. There's more on that to come. But moving on to the cash flow statement. Obviously, the theme here is cash. Cash from sales, cash paid for operating expenses, interest, and income taxes. You will also record the purchase of property and equipment here and the money you received from borrowings. After you complete this sheet, you'll have an output number stating your cash balance at the end of the period. Now, in your business plan, you'll need to include screenshots, which is what I'll suggest, of each of the 3 financial statements, 1 per page. Also in your business plan, the Section 3 submission in the Section 3 submission include a notes section. This is just a Word document with references to individual cells in the Excel financial sheets. In this notes section, you'll describe your reasoning behind each number recorded, whether this is a calculation, the price and projected sales behind your revenues, or receipts from companies or websites. I want sources for all your numbers. This obviously needs to be very detailed. Now, I think that's about all I want to discuss in PowerPoint. So, if we move over to a pricing example. So this business here is focused on a aquaponics operation, which is a system that combines raising aquatic animals such as fish, in this case tilapia, with cultivating plants in water, not soil or other mediums. And this is termed hydroponics. In this plant, the student is growing basil. This creates a symbiotic environment for both crops. Okay. Oops, wrong thing. Here he started out by figuring his price. He projected yield of 12,000 pounds, as he stated here. I can get all this lined up. Yep, okay. Right here in year 1, he projected a yield of 12,000 pounds of basil and is using the price of $9 per pound. This is shown in cell B6. And in B7, he has a revenue based on 2,000 pounds of tilapia fillets at $3.50 per pound. Now he's done a lot of background research on how many pounds he can expect to produce in the facilities and square footage he has. This isn't just a random number. He's recorded and explained in detail all of this in the business plan. He's also shown that he is planning a warehouse expansion in year 3, or column D, thus the increase in revenues on both the tilapia and the basil side. Now, if you have a service revenue to record, this is the place to do it, under the revenue heading. In the cost of goods sold section right here, you notice he has kept rows 10 and 13 blank. This tells the reader that he is not keeping any inventory from year to year, but selling it all. This definitely isn't going to be the case for all businesses, but it sure can help simplify things if it's at all feasible for your business, especially in this class. Again, as he is selling more products in year 3 through 5, his cost of goods sold is also increased in the proper amount. The gross profit in row 14, right here, is found by taking the total revenues subtracted from the total cost of goods sold. Now let's talk through the expenses section of this example. If you use an asset for over a year, it often uses value. To offset the asset's declining value with its costs, you can depreciate the expense. Depreciation reduces the value of an asset over time. So in the aquaponics financials, he's listed out all the equipment and facilities expenses and his startup costs, and then referred to them in his notes. So here in line 18, he's got a line or a note for depreciation, and this refers to the startup costs, which he's listed here for the equipment. He's listed all of his equipment he'll need, the number of units, and the price per unit, and the total cost for each of these different pieces. He also mentioned a 10-year straight line depreciation schedule, which he's attached to his business plan. If you own buildings, furniture, equipment, vehicles, livestock, etc., you'll have a depreciation expense on your income statement and a depreciation schedule in your business plan as well. Now, I'm going to ask you to check out the asset life table. Oops, wrong window. The asset life table here linked in Canvas for the specific life that you should expect and account for each asset. Now, the next expense he's listed is delivery. So if your product or service requires delivering or fuel to produce and transport, you'll need an expense here. Calculate the miles per gallon of the vehicles used and the miles per period, so either monthly or yearly, depending on the year, traveled to come up with this expense. The interest expense is the sum of the interest payments on your loan from the period. From the loan amortization schedule that you'll have in your Excel template, add up the monthly or quarterly payments, whichever you input and are going to pay. So if you pay 4 times a year or 12 times a year, basically. And the interest amounts totaled will be recorded here. Now, the payroll tax expense is also applicable to anyone with employees. Now, in this example here, he's based his tax off the standard 7.65% employer paid taxes. For insurance, I suggest talking to an agent about what coverages you'd need and getting a quote for these. Under the rent, in this example, he's renting the warehouse facilities. Again, he's detailed this in the plan and in his notes section. If you're renting land or office space for your business, you'd record that here. For wages and commissions, he's recorded part-time and full-time wages. Sorry, I guess we're a little behind up here. Part-time and full-time wages. The note breaks down each and describes the increase in wages due to the final build-out of the warehouse or the expansion of business. He's also taken out the owner's salary to make it easier to read. He's gradually increased it based on, again, the warehouse building increase and the increased production. All of these expenses, oh, first I guess we missed utilities. Okay, he also has utilities here to heat and cool and run electricity in the warehouse. And obviously these are going to increase once production, as you can see from here to here, once production and the space needed to heat and cool increases. Now all of these expenses are added up and totaled right here. And then they're subtracted from the gross profit to give you the net income before taxes. The income tax line here is 30% of this row here. Again, you have a note for this as well. But 30% of the net income before taxes is your income taxes, and then this minus this is your net income for the period or the year. Now let's head over to the balance sheet. Okay. Again, these cells has corresponding notes. The cash line is actually taken from the cash flow statement. It's the cash at the end of the period, but we'll discuss that in a second. He has purchased a lot of equipment that he specified in the startup cost section. Remember when we looked at that? The cash line, oops. So he recorded that under the fixed asset equipment line. He's also taken his depreciation schedule, and for each year, taken out his depreciation expense. So for year one, the equipment was worth $153,185, and the depreciation expense was $8,767. So this minus this gives you the year two equipment asset of $144,418. Now, and this trend continues. Now, if we move into the liabilities section down below, we'll start with current liabilities. In these rows, if you've already made all the payments for the year, you can leave these two blank. However, under long-term liabilities, the non-current portion on long-term loans row is where you list the amount of loan from a bank or financial institution that has yet to be paid off. This is the principal payment that has yet to be paid off. Then under, and as you see, it's decreasing year to year until this year. This side note, again, he got that extra loan in year 3 to compensate for that business expansion. So it goes down and then it goes up for the second loan, and then it continues to go down again. Okay, so under owner equity, the investment capital is where you list what you've invested in the business, and retained earnings, this line, is equal to the total assets minus the total liabilities minus the investment capital. Now, as you can see, that equation will make your balance sheet balance. So total assets equals total liabilities plus total owner equity, which again, this is that calculation. These two need to balance. Okay. And finally, the cash flow statement. The cash received from customers, this line here, is the total sales revenue from both basil and tilapia added together in this example. So basically taking these two here, year one, adding those together to give you the year one cash received from customers. Okay, the operating expenses line is obviously the cash paid for those operating expenses. So again, if we head over to our income statement, it's all of these expenses minus the interest expense right here, because that interest expense has its very own line right below on the cash flow statement. And income taxes are also under cash flows from operating activities, and that is found in the income statement as well. As you remember, it's in this line right here. So your year one income taxes will be listed right here, and you can just put that number in right there. Okay, the cash flow from investing activities right here is either from the sale of property or equipment, which most of you won't encounter or have in the first 3 years of your startup, and also the purchase of property and equipment, which many of you will have. Okay, and as I've mentioned before in this example, he's buying quite a bit of equipment and he's, as he listed in the startup section over here. And in year 3, he also has that warehouse expansion that he's accounted for here. And he's listed in his notes section. Okay, the cash flows from financing activities include the loan or cash received from borrowings right here. And this example had one in year 1 and another in year 3. And the cash paid to retire long-term debt is the principal payments totaled for that period, found in the loan and amortization schedule. If you add up the cash flows from operating activities, from investing activities, and from financing activities, you'll get the increase or decrease of cash during that period. The cash balance at the beginning of the period can be the owner investment if you have one in year 1. And then after that, it is the cash balance at the end of the year in subsequent years. So in year 2, it's equal to the end of the period, year 1. The cash balance at the end of the period is equal to the increase or decrease of cash during the period added to the cash balance at the beginning of the period. So these two added together is this. Pretty straightforward. I'll link both of these documents in Canvas for you to further review and look through with more time. And again, come back to me with any questions on those or if you need any specifications. Now, let's move into the template that we're going to be working with. Okay. Next, on the bottom of this template, you'll see that we have a bunch of different tabs laid out. Each of these sheets will probably be required for your business plan, with an exception of maybe 2, maybe. But the startup cost tab, which we're in right here, is where I'd like you to make a list of the things you'll need to start up, like in the example. Have costs and sources associated with each. Next, the income statement. There are some numbers filled in here just so I can demonstrate the formulas, but you'll notice in year 1 that I'm looking for monthly numbers, and then after year 1, December, just annual numbers is fine for year 2 and 3. There are some formulas, like I mentioned, built into this template to help you simplify things for you. For example, this total revenue is already listed in a formula, so it'll add it up for you. Also, cost of goods sold has a formula, as does gross profit. Also, as soon as you start filling in numbers here, you'll see the numbers on the bottom start to change as you increase the operating expenses. You'll see that your total expenses will go up, your net income will go down, and your total income taxes will also go down because your net income before taxes is going down. That's a lot, but I think it was straightforward. Okay, now onto the balance sheet. There are formulas built in. For example, the cash, like I mentioned earlier, coming from the cash flow statement, as soon as you start filling in numbers from your income statement on your revenues, it'll bounce over to your cash flow statement for cash received from customers. And then that will in turn talk to the balance sheet, which will input the cash at the end of the period for each of these 3 years as you begin to fill everything out. So as you start to work on things, it'll just keep working on itself, if that makes sense. Okay, so I also want to mention here that if you have inventory in the cost of goods sold section at the end of the period here, you'll need to say or record that also in this line here on your balance sheet. Now under fixed assets, Again, a lot of you will have stuff listed for property, equipment, land, building improvements, that kind of thing. And again, make sure you're taking out that depreciation each year. So these should be going down as we progress year to year. Again, these assets are totaled already for you with this formula. And then you can head down to your liabilities section. Again, like I mentioned before, a lot of these should already be paid if you're looking at the end of the fiscal year. So if you've already paid all your wages to your employees for that month or year, then you don't need to put anything in this payable column or row here. However, like I mentioned before, record that long-term loan. If you have $150,000 you're borrowing from the bank, if you've paid off, I don't know, $25,000 in the first year, record as much in this row, and then another $25,000. You'll be at $100,000 in year 2 here, and then $75,000 in year 3. Okay. Next, investment capital. Again, that's where you put what you're bringing into the business. And then accumulated retained earnings is that formula already built in to help you balance your balance sheet. Finally, the cash flow statement. This, as I'm sure you've guessed, has formulas. Now, as you can see, it's linked to the income statement. So all of these should already be filled in once you fill in your income statement. If you're purchasing any property or equipment, you'll need to fill that in here in the appropriate month or year. And then also fill in your borrowings, so your loan, whichever year or month you have a loan, and then the cash paid to retire. This is the principal payments, again, for that period. So this one you won't actually have to do much on. As you can tell, it pretty much does a lot for you. Okay, there are 2 more sheets in this template down here. The first being the loan amortization schedule. Now this is where you get to record your loan amount, whether you're asking for $10,000, your interest rate might be 5%, and you're going to pay that off in 5 years. Again, you're going to customize this to whatever you foresee for your business. If you need $100,000 and it's going to be a higher percent or a lower percent, record that as much. If you have any research into the lender name you're looking into or the financial institution you'll go through, include that as well. This is the line where you choose how many payments per year. Most of them are monthly, so 12 payments in a year. And then starting date of the loan you can input here. So some important columns on this loan amortization schedule. First of all, your beginning balance at the beginning of the period is here. Your interest payments, so this is what you'll be totaling up for that interest expense per period. So in that first year, you'll just be including 1 row for each since it's monthly, but in year 2 and 3, since it's annual looks at the income statement, so year 1 is monthly, year 2 and 3, you will have to total 12 of these in the corresponding payment dates of the interest expenses to correspond to that interest expense for the year. Also, the principal payment, again, that's shown on the cash flow statement, the cash paid to retire long-term debt. That totaled for year 2 and 3 will be listed here, and then monthly just for that first year. So that's basically all there. Oh, and then obviously the ending balance is what you'll include on the balance sheet on non-current portion of long-term loans. Okay? Now next up is the depreciation schedule, where you can track asset life and depreciation expense each year. So let's say, for example, I have asset M I'm purchasing at $1,000. I've also determined that its scrap value is $100. And from that asset life table linked on Canvas, I found that it has a depreciation life of 5 years. So taking 1,000, the acquisition cost minus the scrap value of 100 gives you $180 in a straight line depreciation per year. So as you can see in year 1, after that first year of depreciation, it's worth $820. Then in year 2, it's worth $640, $460, $280, $100. Now the depreciation expense that you'll be recording on your income statement and showing in your balance sheet will be that $180 for asset M per year, plus however many other assets you have listed here. You can just group them all together on the depreciation expense on the income statement and the less depreciation row on the fixed assets in the balance sheet. Okay, so finally, I really want to stress the importance of that notes page. Again, we got a quick look at it in, let me bring it up again. There we go. In this example, again, even this could have been more detailed if that tells you anything. This is key for not only me to give you feedback and a decent grade, but also investors and other business professionals who are reading your business plan. Please start on this section 3 as soon as possible and make it as detailed as possible. And as always, let me know of any questions or concerns. I really want to help you guys get this right.